Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Welcome to this episode of Supernatural Stocks, coming to you all the way from Europe, which means I certainly have tourism on the brain because it's always so lovely to go and actually check out that industry elsewhere in the world and see what's happening as part of a broader trip. Now, tourism contributed 10.5% of Italy's GDP in 2023. Some of the other reports that I've seen suggest it is higher, more like 15% even on a direct and indirect basis. The exact percentage isn't the end of the world, but either way, it's big. Still not as extreme as Greece though, which is at around 20% contribution from tourism. Portugal, much the same actually, just below 20%. And don't underestimate those economic powerhouses, France and Germany, in this regard. Both of them sit with tourism contributions of just below 10%, actually more than I expected and not very far behind Italy. Now, bringing it back home and making it more useful to us as South Africans, tourism contributed 8.2% to GDP in 2023 back home. When you consider our combination of incredible natural beauty, wonderful food and rich heritage, not to mention our great wildlife, our warm coastal waters, in certain places at least, and a certain mountain at the tip of Africa, it's actually quite disappointing, let's be honest, that the contribution is not higher. As I reflect on a week of great travel and fact-finding in Istanbul and Italy and a variety of learning experiences along the way, it's clear to me that a couple of things need to change for South African tourism stocks to really reap the rewards of the natural beauty and very cheap prices by global standards. It really is great that it doesn't cost 30 euros to travel roughly 5 kilometers by taxi in South Africa because your legs have finally given up on your trip. Then again, South Africa is not a place where you can safely walk everywhere. So the first issue here is your legs won't actually give up in South Africa because we dream of a world in which we can walk as much as you can in Europe. Safety and security is the drum that everyone needs to keep beating, no matter how tired we get of it. Transport infrastructure, that's right up there in terms of importance, because we just don't have the transport systems in place to compete with the European cities for tourists. We are seen as more of a wild destination, a bit of an adventure, rather than a place of walkable cities, and that's with good reason. And much as nobody wants to see billions in taxpayer money wasted on a national airline, and goodness knows we still have PTSD from that in South Africa, it is amazing to walk around Istanbul and see the immense pride they have in Turkish Airlines. It has made a huge difference to the Istanbul tourism scene, with initiatives in place to encourage stopovers. This is a collaborative effort with an efficient visa system and a tourism hub in Istanbul that is safe and worthy of a visit. To maximize the benefit, the public sector and the private sector have worked together here, and there's a strong lesson in that. Then again, nobody seems to care that they aren't arriving in Venice on an Italian airline. If the destination is desirable enough, it doesn't really matter. The point here is that the right airline can actually make a place more desirable, as we've seen in Istanbul, and certainly Dubai as perhaps the best example of this, thanks to the heroics of Emirates. Geographically, of course, those cities are perfectly positioned to connect east and west and be hubs for tourism. The same can't be said for OR Tambo International, unfortunately, just based on where we are in the world. I can dream at least, much like dreams of trams running up and down Cape Town roads, thereby negating the need for so many cars in our cities. There are a lot of initiatives that we can't copy in South Africa, but there are many areas where I think we can get better. And if the GNU does start to get some of this right at least, then what could be the right stocks to consider on the local market for a tourism theme? The old school heroes are the casino groups. For various historical reasons, our local tourism stocks have a heavy slant towards gaming and gambling. This is actually very different to the US market, for example, where you can choose from hotel groups of all kinds, through to cruise companies and airlines. Here in South Africa, you need to make do with a small number of options if you believe in an upswing in tourism. At Sun International, for example, of group EBITDA of 1.6 billion rand for the 6 months to June, 1.1 billion rand was generated by the urban casinos segment. Now, this is anything but a growth area, unfortunately, / fortunately, depending on your views on gambling, I guess, with flat casino income and a 4.1% dip in EBITDA. At this stage, the casino assets in South Africa are seen as cash cows and mature businesses rather than growth assets, generating an adjusted EBITDA margin of 33.1%. Capex was 4.4% of income, so the economics remain lucrative. I just think that the best days of these casino resorts are behind them, especially if I consider my peer group of 30-somethings. None, and I mean none of them, are trying to go to Sun City on holiday. But within Sun International, the purest play on tourism is the resorts and hotels segment, which saw adjusted EBITDA of 346 million rand, up 10.2%. With an adjusted EBITDA margin of 22.9% and capex at 4% of income, it's not as lucrative as the casinos, but it's still decent, and the difference is that at least it is growing. An improvement in international inbound travel will help this business increase its pricing and improve its margins. Unfortunately, there's just too much noise in the group to actually make this a pure enough play on tourism. The same is true for Tsogo Sun, which is arguably even more built around the casino and conferencing model rather than pure international inbound tourism. That means we need to look elsewhere for the tourism play. The brightest sun of all at the moment is Southern Sun, bringing us neatly to another company with sun in its name. Southern Sun has been the one to own this year, with the share price up a massive 60% year to date. It's not clear why that is if you only have a cursory look at the recent trading update for April to August 2024, where trading metrics are only slightly up. Group occupancy is 120 basis points higher at 57.1%, and the average room rate is up just 1.7%. These are the key drivers of top-line growth, and neither metric is exactly shooting the lights out right now, or at least it looks that way until you read further. Still, Southern Sun is the purest way to take a view on international inbound tourism in our market, as well as general business activity. There is no getting away from the conferencing angle here, with the BRICS Summit having been a major boost in the base period. And this is one of the reasons why the year-on-year growth looks unexciting, because in reality, they actually managed to grow versus a base period that included the BRICS Summit, hence why the market seems quite happy with the recent performance. Now, there is nothing wrong with being exposed to business travel alongside tourism. In fact, business travel is usually less cyclical than tourism, with the world's best hotel groups offering a combination of inner-city business hotels and more leisure-focused options as well. The other thing the market likes is that headline earnings per share, or HEPS, will be at least 20% higher for the 6 months to September, thanks to solid capital allocation decisions around share buybacks. We now move on to City Lodge, which is more of a short left if I'm honest. Thanks to how weak the rand is on the global stage, most international inbound tourists will splurge on more upmarket hotels in South Africa because frankly, an upmarket hotel in South Africa costs you the same or even less than a really average hotel in Europe. City Lodge has always focused on being a more affordable option, which leaves the group with a customer base that is more local than international. Now, there's nothing wrong with this, of course. It just means you need to form a view on local travel. With interest rates coming down and the fuel price as well, I think it's quite likely that an upswing in domestic travel will be experienced. South Africans love exploring their country, which bodes well for City Lodge. With the share price up just 6% this year versus 60% at Southern Sun though, we are dealing with 10 times outperformance. I think the market is sending a pretty clear message here about the more appealing business model, and I do tend to agree that overall Southern Sun has more of a moat than City Lodge. We finish with a left field option, and that is Zeda. With a 10% increase in the share price this year, Zeda, and that is Z-E-D-A, not Z-E-D-E-R, also doesn't get close to what Southern Sun has achieved. I hold the stock and I'm pretty happy with how things are looking though, as Zeda is a mobility company that makes up for our public transport shortcomings by offering car rentals. Renting and driving in Europe is mildly terrifying, and there's a great transport infrastructure alternative, so I'm not mad about the car rental model in developed markets. But as for South Africa, our roads are a whole lot less chaotic than they are in Europe, and many of our attractions are quite some distance apart, making car rental a sensible option to get around. Currently trading on a price-earnings multiple below 4x, Zeda is cheap despite the decent returns thus far this year. Yes, a downturn in used car prices has an impact here, but I still like this stock in a decreasing interest rate environment where people should have more money for local travel. And of course, if we're getting international tourists through the door, which we certainly seem to be, that's a bonus because they still need to get around. Let me know in the comments on the article on the Moneyweb website whether you have any exposure at all to local and international stocks and which stocks you hold, or if you avoid the sector altogether for fear of it simply being too cyclical and too competitive and perhaps just too difficult. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.